As we check the numbers right now on Friday, May 22, 2026, the live intraday trading for Rezolve AI PLC, under ticker RZLV on the NASDAQ, shows the stock trading at exactly $2.60 per share, marking a solid upward movement of 4.84% so far in today's session, with a volume of over 123,000 shares changing hands. While a quick look at your standard trading app might make this look like a routine small-cap bounce, what is actually happening behind the scenes right now is a dramatic collision between retail perception and hard enterprise data that most retail traders are completely missing. Most casual observers looking at smaller tech plays assume that massive revenue guidance spikes in this sector are just speculative smoke, but Rezolve AI just dropped peer-reviewed verification data displaying near-perfect transactional accuracy that addresses the multi-billion-dollar distortion issue stalling global retail automated checkouts. This isn't just about software updates, it's a direct challenge to the general belief that smaller specialized tech firms can't compete against major infrastructure giants, creating an entirely new dynamic for anyone engaged in online investing today. When most people look at a stock in this category, the expectation is that it will simply follow the broader market sentiment or track major megacap swings like Tesla stock, Apple stock, or Nvidia stock. The retail crowd often turns to popular retail platforms like the Robinhood app or uses basic self-investing tools to chase high-flying names, operating under the assumption that a small-cap software player valued under $1 billion is inherently too risky or lacks enterprise validation. The reality, however, is that while retail traders are busy monitoring day-to-day volatility on general investing sites, institutional players and enterprise partners are looking at fundamental architectural shifts in how businesses actually deploy software. Rezolve AI recently announced that its proprietary traceware technology achieved between 99.5% and 100% user state accuracy across testing that evaluated massive foundation models, effectively eliminating the text generation errors that cause commercial transaction failures. This massive contrast between what the public thinks is happening, which is just another speculative technology ticker, and what is actually happening under the hood, which is the structural validation of enterprise software, is exactly where the tension lies in the current market. Looking closely at the recent stock movement, the daily swings for RZLV have been incredibly telling, bouncing from a 52-week low of $1.90 up to today's levels, though still well off its 52-week high of $8.45. This price action reflects intense ongoing debates within the institutional community regarding valuation and near-term execution. Trading volumes have shown sudden, sharp spikes on days when major commercial updates are announced, indicating that large block traders are quietly establishing positions or adjusting their risk profiles. Institutional activity currently accounts for roughly 24% of the outstanding shares, while mutual funds and exchange-traded funds hold around 4.35%, leaving a massive portion in the hands of the public and retail investors using platforms like Interactive Brokers Trading or setting up a specialized individual brokerage account. This high retail concentration is precisely why the stock experiences such dramatic intraday volatility, as individual traders frequently react to short-term technical indicators rather than analyzing long-term commercial contract pipelines or gross margin sustainability. Recent earnings reactions have added fuel to this fire, highlighted by a staggering acceleration in the second half of the previous fiscal year, where revenue grew by over 540%, culminating in full-year audited revenue of $46.8 million and the company's first positive adjusted EBITDA month in December. Even more impressive to professional analysts using high-end Interactive Brokers platform tools is the first quarter report for this year, which revealed a massive revenue surge to $60 million, meaning the company brought in more revenue in a single quarter than it did in the entire previous year combined. Management has set an aggressive full-year revenue guidance of $360 million, a projection that has forced serious research firms to take notice. Analysts from firms like H.C. Wainwright and Cantor Fitzgerald maintain aggressive buy ratings with price targets ranging from $8 to $12, implying massive upside from the current $2.60 live price. For someone managing an account through Schwab Intelligent Portfolios or reviewing their long-term assets within Fidelity Wealth Management, these numbers stand out because they represent a fundamental departure from typical pre-revenue software speculations. To understand why this momentum is shifting, we have to look at the broader sector momentum and the overwhelming macroeconomic pressures facing the software industry. Higher interest rates and tighter corporate budgets mean that enterprises are no longer spending capital on speculative software experiments. They demand immediate, measurable efficiency. This corporate belt-tightening has severely impacted general technology valuations across the board, but it simultaneously creates a hyper-focused demand for specialized platforms that directly convert user interactions into completed error-free sales. This is where the core business model of Rezolve AI comes into play.
Founded in 2016 and headquartered in London, the company operates a specialized suite combining its deep search engine, known as Brainpower, with its transaction verification layer, Traceware. Instead of forcing retailers to build their systems from scratch, they offer an integrated platform that plugs directly into existing digital storefronts. This allows corporate clients to offer automated shopping, voice-driven checkout, and instant product discovery with a core software margin exceeding 90% and an overall gross profit margin holding steady at a remarkably healthy 66%. This business model is supported by heavy enterprise distribution channels rather than traditional expensive direct sales teams. For instance, the company recently secured a massive global strategic partnership with Tata Consulting Services, one of the largest technology services firms in the world, which will actively resell the platform to its enormous enterprise client base globally. Furthermore, they integrated their specialized models into Microsoft Software Foundry, allowing global brands to deploy automated commerce assistants directly within the Microsoft Azure infrastructure. More recently, a multi-million-dollar strategic partnership was inked with Enhanced, listed on the New York Stock Exchange under ticker ENHA, where Rezolve AI will act as the core technology provider for their direct-to-consumer digital telehealth platform, while gaining prominent branding rights during globally broadcast sporting events. These structural connections are crucial for long-term survival, especially when individual investors analyzing financial software via Robinhood stock trading or active accounts on the SoFi trading platform try to separate real enterprise adoption from simple marketing hype. Let us pause for a moment to look at the broader landscape of how people approach online investing today. Whether you prefer utilizing automated tools like a SoFi robo-advisor, managing a traditional portfolio through Fidelity Investments, or actively executing short-term strategies using Robinhood Investments, the core challenge remains exactly the same: identifying structural dislocations before the mass market catches on. Please comment below with how many shares of RZLV you currently hold, or if you prefer sticking to larger technology names for your long-term portfolio. Gathering this direct feedback helps gauge exactly where retail sentiment stands relative to institutional positioning, which is vital when navigating highly volatile software plays. When you contrast the prevailing public expectations against the underlying corporate reality, a clear structural gap emerges. The public expectation, driven by looking at a volatile chart on standard investing sites, is that this company is just another microcap software play struggling to find its footing in a market dominated by massive tech conglomerates. The reality, backed by recent financial filings and peer-reviewed computer science research, is a company scaling its quarterly revenue at an exponential pace while securing distribution agreements with trillion-dollar cloud infrastructure providers. However, this reality also includes significant structural risks that any sober investor must consider. Despite the massive revenue scaling and the high software margins, the company reported a substantial GAAP net loss of over $100 million in its last audited annual cycle, driven by heavy research and development spending and listing costs. The company is currently unprofitable on a net income basis, losing roughly 38 cents per share over the last 12 months, which means they are completely reliant on hitting their massive revenue guidance targets to achieve sustainable, long-term self-funding. Looking forward, there are several distinct catalysts and risks that will dictate whether reality can ultimately match or exceed these elevated market expectations. The most immediate catalyst is the upcoming presentation at the International Conference on User Modeling and Personalization in June, where the technical validity of their anti-error technology will be scrutinized by the global scientific community. If enterprise clients see this data validated by independent third parties, it could dramatically accelerate contract sign-offs. Another critical milestone will be the execution of the full-year revenue guidance. Hitting $360 million requires flawless operational execution across their global partnerships, particularly through the Tata Consulting Services channel. On the risk side, if corporate spending slows down further due to macroeconomic headwinds, or if tech giants integrate similar verification features directly into their own foundation models, smaller platforms could face intense pricing pressure, threatening those high 90% software margins. For investors using advanced online investing tools, tracking these developments requires moving past basic retail sentiment. Those utilizing Fidelity brokerage tools, active monitoring via the interactive broker's account layout, or setting up automated baskets through Schwab Intelligent Portfolios must closely monitor the quarterly cash flow statements and the pace of institutional accumulation. If institutional ownership begins to climb past that 24% mark, it will signal that professional money managers are becoming comfortable with the path to net profitability. Conversely, if retail concentration remains excessively high on platforms like Robinhood app setups or standard SoFi investing accounts, the stock will likely continue to experience violent, sentiment-driven price swings, regardless of the underlying corporate progress. The future outlook depends entirely on this balance, whether the massive operational scaling can outpace the cash burn before the market's patience runs thin. To summarize the core insights of this analysis, the narrative surrounding Rezolve AI is a classic textbook example of the ongoing friction between short-term market expectations and long-term enterprise reality. The expectation of the general trading public is shaped by the stock's historical downward trend from its prior highs, viewing it as a speculative asset with high volatility. The underlying reality, however, is defined by an accelerating enterprise software business model that is actively delivering massive quarterly revenue growth, maintaining exceptionally high core software margins, and validating its proprietary technology through rigorous peer-reviewed testing. By securing critical critical global distribution pipelines through major technology services firms and cloud infrastructure networks, the company has built a legitimate foundation for enterprise scaling that defies its current small-cap market footprint. Yet the persistent reality of net unprofitability and high retail stock ownership introduces a layer of structural risk that cannot be ignored. Whether you analyze this through sophisticated individual brokerage setups, long-term fidelity IRAs, or fast-paced retail trading platforms, the true value will be determined by whether management can successfully translate their massive enterprise pipeline into positive net earnings over the next 12 months, proving that their real-world performance can permanently close the gap with the market's highest expectations. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.